the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the standing deposit facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%. The MPC also decided unanimously again to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced.
Governor Sanjay Malhotra there giving the outcome of his first Monetary Policy Committee meet. And yeah, the big news coming in is that, as expected, the repo rate has been cut by 25 basis points. The central bank's lending rate to other financial institutions has been cut from 6.5% earlier to 6.25% now. But that's not all. The RBI governor has also given some projections on the growth rate of India's GDP for FY26 and also inflation targeting both for this quarter of the present financial year as well as the overall and quarterly split for the next financial year. So growth is expected to come in at about 6.7% for FY26. That is what the RBI governor has just mentioned a few minutes back. We are looking at revised growth estimates for next year at about 6.7%. Remember, this would be about 3 points higher or 0.3% higher than the growth estimate for this financial year, which has been revised by the Ministry of Statistics to about 6.4%. The next financial year, we are expected to grow faster at about 6.7%. On inflation targeting as well, the RBI governor has mentioned that the quarter 4 inflation print, the headline inflation for this current quarter of January, February and March will come in at about 4.8%. Lower than the 4.9% for the previous quarter. And going forward, the inflation targeting for FY26 has been made at about 4.2%. So these are the updates of the Monetary Policy Committee meet. The RBI governor has also said that the RBI is committed to walk the tightrope between inflation management as well as the economic growth of the country. And that seems to be the underlying message of the decision of the central bank at the MPC. In addition to that, the RBI Governor, Mr. Sanjay Malhotra, has also gone on to say that the RBI will work to ensure there is enough liquidity in the system. He's mentioned that India's forex operations are also going to be market determined. The price of the rupee, which has seen record lows in the last few days, is going to be determined by market forces. And the RBI, despite the open market operations, still has enough and more forex to cover India's needs for more than 12 months. India's forex reserves stand at about $630 billion. Joining me to make sense of the RBI governor's latest decisions is economist Mitali Nikore. Mitali, good morning. Thank you for joining us. As expected, there's been a 25 basis points cut in interest rate. What does this mean for the consumer who's grappling with high inflation? Inflation hasn't come down to the 4% target that RBI has maintained for the last many years. And even Shaktikanta Das, the previous RBI governor, kept hammering the inflation down by hike after hike until 2 years back. But inflation still above 4%, RBI decides to cut interest rates.
Absolutely. First of all, good morning. And I think thanks a lot for having me on the show. And I think, this is something we had been expecting since December. Since the previous RBI MPC meeting, we were actually expecting the rates to be cut in the previous meeting itself, but they were held constant at that time. And, now with the new RBI governor coming in, it was widely expected that, we would be seeing this rate cut, and this rate cut has come through. Now, what does this really mean for the liquidity of the consumer? I think one message is very clear from the government as well as from the RBI, that the focus is on empowering the Indian consumer. Whether it's the tax cut that has been passed on to the middle class, or the cut in the interest rate that is again going to benefit the middle class, both the measures together are really empowering the Indian consumer to go ahead and restart their spending. The spending cycle has to be restarted, and that's something that's very clear from this rate cut. The second thing is around investment. I mean, the rate cuts also have a positive impact on private sector and domestic sector investment. So I really think that, with this rate cut, we might start seeing some amount of softening in the investment cycles, and, private sector, domestic private sector investment also getting reignited with this rate cut. So both these are, coming together, the tax cut and the
Yeah.
rate cut, and this is very good news.
Right. So, Mitali, help us understand, one part of the RBI rate cut is tackling inflation, inflation management, and the other side is propelling growth, and the cost of capital comes down. What happens to now, let's say, people who want to go ahead and take home loans or car loans and really kickstart that consumption cycle that in urban areas has been weak? And parallelly, what happens to the investments that they have made in, let's say, instruments like bank deposits?
So I think again these have two different impacts. If you want to go ahead and take a home loan or a car loan today, that's definitely going to be cheaper because the rate has been cut, the interest rate, repo rate has been cut, and this is generally passed on by private banks to their consumers, especially to middle class consumers. This is likely to be passed on for restarting the investment and consumption cycle. So definitely home loans, car loans, and your EMIs as well, even on your existing loans, likely to get cheaper. So again, more money in the pocket of the consumer. But on the other hand, for those who are saving and who have saving instruments, sometimes these are also passed on in fixed deposit interest rates are also reduced, and the payouts on your saving instruments might be reduced. But sometimes banks may say, okay, we will not pass on that rate cut in, for example, the returns that you're getting on long term saving instruments. So they might pass on the rate cut only in the short term saving instruments. So if you have saved for 5 years or 7 years, maybe you will see your return lower. But if you have saved for a good 20-year instrument, then you might not see any decrease in your returns because that might not be passed on by the private banks.
So, Mitali, how long before banks actually pass on the RBI's rate cut decision to consumers, both on the end of home loans and car loans that people want to go ahead and take, and also on the fixed deposit? So, if I remember right, and correct me if I'm wrong, it's usually the interest rate on fixed deposit that gets slashed immediately, but the home loans actually take much longer for banks to pass on to consumers.
Absolutely, Kartik. We would want it to be the reverse, isn't it? We would want that the FD rates should be held for some time, and
Yeah.
then the loan rates should be cut immediately. But of course, banks have their own systems, and I do expect that within this week we'll start seeing some changes in the home loan rates and car loan rates, as well as a lot of fintech platforms now coming in. See, as we have more and more competition in the market, as we have more and more lenders available in the market, the speed at which the rate cuts are passed on to consumers will become faster. And I think at this point in time, the Indian financial markets have evolved to a great extent. We have a whole lot of financial tech, fintech lenders, who are now starting to operate out of centers like Gift City and other fintech hubs in the country, especially Mumbai as well. And I do expect that these will be first, these will be the first lenders to start to pass on this cut entirely to the consumers, and then the bigger banks will follow through the week. And definitely the FD rates, I expect that by tomorrow morning, we will all have emails sitting in our inboxes saying your FD rates returns will now be revised in line with the RBI announcements, and I generally find that to be the very next day that we start to see that in our inboxes.
Right. Now, help me just understand one more thing, Mitali, since you're here with us on this very important day. What happens to the INR? How is the rupee going to get impacted with this rate cut? Because to my understanding, now the differential between, let's say, the interest rate that US offers and India offers narrows with this rate cut. So does this mean more flight of capital, more flight away from India's bond market? And will that come into India's equity market, or is that going to leave India altogether? And hence, what happens to the rupee against the dollar?
So, see, what happens in this case is a little bit complicated because there are two effects again at play. The first effect that's at play is that now it's today cheaper to invest. If you're getting a loan from the market, from any of the bond markets, if you're getting a loan from even a debt market, that is actually cheaper to now invest in Indian equities. Indian equities suddenly become a bit, more accessible. So there is also an inflow of, foreign capital which is looking for, say, longer term investments and can come in and borrow on the Indian debt market and then invest in the Indian equity market. So I think, there's one effect which actually is a positive. And the negative effect is actually for the foreign institutional investors, the short term investors who are looking for, the differential return to make on that differential return. So of course, as the differential narrows, they will be the ones exiting. And we have seen in the last 6 months, in any case, the FII activity has been, of the nature that they are exiting the Indian equity markets simply because of the, developments in the US markets overall with President Trump also coming in. So I think, what is happening in the FII markets is a little bit outside of the domestic control. It's outside of RBI's control. But surely, this will help to attract some more FDI by making it cheaper to borrow in India and then invest in India, which is a route that some of the FDIs are starting to take. I mean,
All
it's
right.
it's not a very popular route, but it's starting.
All right. And I think the RBI governor also more than once, Mitali, mentioned the fact that geopolitical tensions, geo-economic concerns, as well as climate, weather-related patterns are going to impact inflation. What are some of these? See, whether we understand, of course, we can't really control what is the rainfall in the country or outside going to be, but what are the other geo-economic factors right now that may have a bearing on inflation? And the fact that the RBI governor has kept the RBI stance at neutral, which means the interest rates could move either way depending on what happens in the world. So explain to us what this stance really means and what are the macroeconomic factors, international and domestic, that can move inflation targeting either way.
So I think first of all, Kartik, we should realize that with this rate cut, there will be a upward impact on inflation. If everything else is held equal, ceteris paribus, as we say in economics, definitely inflation would increase because we are seeing consumption activity increase, investment activity increase means inflation will go upwards. However, in order to manage that, what the RBI is sort of saying is that we are investing in improving supply chains because the three major reasons why inflation goes up is one is fuel prices, the second is food inflation, and the third is general consumer inflation. So by improving supply chains, we can at least manage food and general consumer inflation. However, having said that, we've been covering inflation and we've been covering these climate related constraints for the last 5 years and 6 years that I've been working with you. And I honestly feel that more could be done on this area. We should have seen more fiscal investment. We should see more public sector investments to strengthening and making our climate resilient supply chains real. We can't just say, oh, the weather is beyond anyone's control. We now have, technology to predict, even complex weather patterns. We now have technology that we can leverage to measure, when is at least a 3 day or 4 day advance notice on what kind of rain is, for example, going to come in. And we have technology for improving storage, like, for example, silo bags, which is a very, like a very flexible technology to store grains That's just one example. I mean, there are so many other examples of technology out there. So I do feel that we need to invest better in making our agricultural supply chains far more climate resilient. We need to invest in better seed technology, and I don't think that on this we can give the government any rope or leeway to not perform anymore. I mean, on this front, I really feel that more needs to be done.
Quickly listen in again to what RBI Governor Sanjay Malhotra said just a few minutes back on his rate decision. Mitali, stay with us. We will come back to you.
MPC also decided unanimously again to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. With this, now I come to the assessment of growth and inflation. First of all, growth.
Okay, so growth and inflation targeting has also been done by the central bank, and inflation targeting at 4.8% for this quarter and 4.2% going forward. And on the growth front, the RBI is saying that Indian economy is expected to grow at 6.7% for the next financial year, FY26. Mitali continues to be with us. Mitali, 6.7% on real terms, add a 4.2%, 4.8%, I think for next year, the inflation targeting 4.2%. So 6.7% plus 4.2%. Are we looking at the kind of nominal growth rate that we want for the Viksit Bharat and 5 trillion economy to come true?
So I think, Kartik, we've been discussing this since the day the budget came out, right? I mean, how do we meet this 8% real GDP growth target? And, at the end of the day, I definitely feel we have to understand we are still the fastest growing emerging economy in the world, and even if we weren't the fastest, I mean, though we could be the second or the third, and we could still be, on a higher base effect doing very well. So there have been a huge amount of number of people who've been lifted out of extreme poverty. We've been seeing our urban infrastructure improving. We've been seeing our logistics infrastructure improving. We've been seeing our agricultural productivity improving. So there is no doubt that in the last 10 years or 15 years we have done extremely well as an economy. However, like you said, to go forward, it is now extremely essential to kickstart not only the standard engines of the economy, which is consumption, as has been done with the combination of the tax rate and this rate cut that has been announced today, but also to make our economy more innovative and climate resilient. If we don't work on those two areas, then it will be very difficult for us to achieve the targets of a Viksit Bharat. Today we have to compete with global giants when it comes to artificial intelligence. We have to compete with global giants when it comes to even making making their supply chains more climate resilient. I mean, even countries like the US are talking about, investing in places like Greenland only because of the kind of minerals and metals that are available in Greenland. So I
Right.
think, we really have to start becoming more forward looking and innovative in some of the growth trajectories and the schemes that are being introduced. We have to think about how can we bring in more private investment into high tech areas.
Right. Mitali Nikore, thank you so much for taking out time and joining us on this very important day. Remember, the RBI has decided to cut repo rate by 25 basis points.